I'm Alan Kenny, Editorial Director with REIT.com, and I'm in Chicago for REITWeek 2013, NAREIT's Investor Forum. Joining me is Lukas Hartwich, Analyst with Green Street Advisors. So Lukas, you focus on the lodging sector. Now, that tends to kind of differentiate between REITs that focus on business travelers and leisure travelers. Do you have any feelings as to which might be kind of better positioned in the current market environment?
Yeah, that's a great question. So the short answer is business hotels have tended to do better. And the reason why is if you take a step back and look at where we've come from, it makes a lot of sense. So who was hit hardest in the downturn? It was the consumer, who makes up the majority of leisure travel. So they were kind of hit with a double whammy. They lost their jobs, and another factor was that the value of their homes, which makes up a considerable portion of their net worth, clearly was hit pretty hard. And so that segment of the market's been hurting and reeling from that. Now, if you look at corporations, they've been able to cut expenses pretty dramatically and maintain profitability. And if you look at metrics like the S&P 500, profits are at all-time highs today. And so that segment of the market is definitely doing much better than leisure. Okay,
now are any of these lodging REITs starting to kind of get some pricing power back?
Yeah, no, definitely they are. I think what's interesting is that today, if you look at RevPAR growth, the majority of it is coming from rate growth. And while there is rate growth, it isn't as strong as prior recoveries. And the biggest explanations for that are both leisure, which we just talked about, and more so group business. So group's really been lagging. Group caters, it's 10 or more rooms booked at once. And that segment of the market is really tied into overall macroeconomic activity and just a robust economic environment. And we're just not seeing that today. When there's competition for employees, that's really when you see that sort of business pick up. And with the slack in the labor markets today, we just don't have the strength in that segment of the market. So, we're talking that's 30 to 40% of the demand for the types of hotels that the REITs own. And so until we see that business come back in a big way, you're probably not going to see the same pricing power that the REITs had in prior recoveries.
Okay, so let us in on what's going to be the big story in the lodging REIT sector in the second half of the year.
Yeah, it's a great question. It's something I think a lot about. I think there's a lot of exciting things to kind of keep your eye on. But for me, it's how are we going to keep up this momentum? We're in 13. We're entering. Well, I guess we're in the middle of our fourth year of RevPAR growth in 6% plus range. And that's pretty remarkable when you consider how lackluster the macro environment is. And so I really want to see what's going to continue driving it. Are we going to keep up momentum? I'm somewhat skeptical that we will be able to, but if we see the economy pick up or we see group come back in a big way, I could very well be wrong. But I think that's what's going to be really interesting. How is momentum maintained and how do we do that?
All right. Well, Lukas, thank you so much for your time.
Thanks for having me.
And for more on this and other REIT news and analysis from REITweek 2013, be sure to check out REIT.com.